With this strategy, understand and recognizing the sudden change in the market and trade with it. What does convergence mean? Market convergence describes a situation where the price of your assets move in the same direction as the value of another asset, index or any other related item. This index is placed at the opposite point of divergence. For example, let's assume a situation where the market prices show an uptrend and so does our technical indicator. In this case, we are facing a continuous uptrend and there is a possibility that this trend will continue. In such situation, the price of the assets and the technical indicator will convergence, follow the same direction, and the trader may refrain from selling the assets because there is the possibility of further price growth. In the most cases, traders refer the convergence as a way to describe the price action of the trade in the futures. Divergence in technical analysis occurs when the share price in the price chart acts against the indicator. Divergence can indicate the return of the share from the trend of the continuation of the direction from the trend, correction of the previous trend. Divergence can act as reservoir pattern or a continuation pattern. Divergence can also be used to identify potential support and resistance levels. Divergence, for example, when the indicator is uptrend and positive but the price is downward and trade in buying is selling and warns the trader that he should make new decision about buying or holding shares. Divergence helps analysts identify sensitive price points. Divergence in indicator is one of the most powerful signals in technical analysis. Types of divergence. 1. Ruler divergence. Normal divergence is a state of divergence that occurs to the opposite behavior between the indicator and the price chart at the end of the trend. By identifying the normal divergence, we accept a change in the direction of the trend and a performance similar to reservoir pattern. Normal divergence has two types according to the trend and prediction it makes. Number 2. Negative standard deviation, RD negative. These types of normal divergence occur between two price selling and the of the end in uptrend. In a price chart, a new selling is formed above the previous selling, but the indicator cannot detect this. At this time, it is said that negative normal divergence has occurred. The probability that the market will decline after this event is very high. Negative divergence sign of a strong seller and weak buyers and does not predict favorable future for the share. 3. Positive normal deviation or the positive. Unlike the negative divergence, the normal positive divergence occurs at the end of the downtrend between the price flow. In this way, the price in the price chart makes a floor lower than the previous floor, but the indicator cannot recognize it. A positive normal divergence indicates the strong strength of buyers and the weakening of the strength of seller. After identifying the positive divergence in the chart, according to the indicator, we accept price growth for the share under review. Number 4. Positive hidden divergence at the negative. At the end of the uptrend, when the indicator makes a low below its previous low, the price chart is seen to make a high above the previous low. This event indicates the correction of a positive hidden divergence, and if observed, it is predicted that the price will continue its upward trend. These types of divergence is also occur at the beginning of the ascending channel. Thank you for watching this video and liking this video. I told a strategy that is very useful for you. 5. Negative hidden divergence. It's the negative. Unlike the positive hidden divergence, these types of divergence form at the end of the downward trend and indicates that the price will continue to decline. We can even accept this Tip of divergence to from at the off beginning of a downward trend channel. To identify the hidden negative divergence, we must pay attention to the formation of selling downward trend. When in the price chart a lower selling is formed, then the period selling, but in the indicator and in the same time frame, a selling is a formed high. Then the period selling negative hidden divergence has been created. This strategy is designed in such a way that there should be support or resistor area for hour and daily time frame. Example of next resistance is small time. Example 15 or 5. Wait for it to reach the horse area. Add income to the area strangely. With the RSI and value indicator, we can gauge whenever the price moves up, but the RSI moves down. It means that now the price is forming at the bottom. Then the volume will be lost and lost, so a good trend change is accepted. Maybe sometimes it goes up and collects the stop or liquidity. Come down hard, sometimes it doesn't come, sometimes it doesn't come down anymore. The trend is much stronger than that. Thank you for coming with me to this important area. Changing to the sudden progress is important. I hope you can use it.